Ladies and gentlemen, a very warm good afternoon to all of you. I, on behalf of our executive body of NFRA, along with my esteemed colleague, Mr. Vidyadhar Kulkarni, our senior consultant, have great pleasure to welcome each and every one of you to this significant and insightful webinar on documentation of audit strategy and audit plan as part of NAFRA webinar series. Friends, in the ever-evolving landscape of financial reporting, the role of auditors is more crucial than ever. Today's webinar focuses on a theme that is not just a mere procedural exercise. It is a paradigm shift in our approach towards audits. The theme, Thinking Audit, Not Taking Audit, encapsulates the essence of our discussion, moving beyond the routine and mundane, and instead fostering a mindset that emphasizes strategic thinking in the audit process. Auditing is not merely about ticking boxes and fulfilling regulatory requirements. It is about critically evaluating the financial information, identifying risks, and providing valuable insights to our esteemed stakeholders. The documentation of audit strategy, therefore, becomes a key aspect in this context. It is not just a record-keeping exercise. It is a manifestation of thoughtful planning, risk assessment, and a proactive response to the challenges posed by an increasingly complex business landscape. Our goal today is to delve into the intricacies of crafting an audit strategy that goes beyond the surface, a strategy that reflects a deep understanding of the client's business, industry nuances, and emerging risks. Friends, we are privileged to have with us today esteemed speakers who are experts who will share their insights, experiences, and best practices. Their collective wisdom will enrich our understanding and inspire us to elevate audit practices to new heights. This webinar is not just an information-seeking webinar. I urge all participants to engage actively, to ask questions, and contribute their perspectives. It is an opportunity for collective learning and growth. I place on record our sincere gratitude to our executive body and our honorable chairperson for guiding us in all our endeavors, including the conduct of this webinar. I wish that our discussions today shall pave the way for a future where audits are not mere checkboxes, but strategic tools to contribute significantly to financial transparency and accountability. Let us embark on this journey of redefining audit strategies together. Thank you. Yeah, I now request our senior consultant, Vidyadhar Kulkarni sir, to take over.
Yeah. Thank you, Shyamji. At the outset, I would like to again thank executive body of National Financial Reporting Authority, Dr. Ajay Bhushan Pandey, Chairperson NFRA, and Mr. Praveen Kumar Tiwari, Member NFRA, and Smita Zingran, NFRA, and our other senior colleagues here for facilitating this important activity of outreach with our stakeholders. And of course, it's my now pleasure to introduce the technical experts for this session today. And my colleague later will also brief on and our plan for these sessions later. So today for this session, we have two expert speakers. One, my good friend Amitesh Datta, who is partner with Pricewaterhouse and affiliates in India. And he has wealth of experience, 30 plus years of experience in auditing and dealing with helping the domestic large listed companies and MNCs and IPOs and various areas relating to the financial reporting framework. And he has played a key role in driving transformation and innovation in the audit, and has been instrumental in setting up quality policies within the firm Pricewaterhouse. And he has also been speaker in various forums and regulatory bodies, and more importantly, he also guides and he mentors a large team of professionals in his firm. Of course, like today, you see, he has also taken the our invitation and going to share his wealth of knowledge with the rest of the profession here in India. And he has been sort of an advocate of transforming the audit profession with use of new tools called, you can call them next gen audit tools and bots such as RPA, Power BI, etc. So this is a sort of a brief introduction about Amitesh Dattaji. And our second speaker is Mr. Sahil Arora, who is a partner in assurance and practice of Pricewaterhouse in India. I has an experience of more than 2 decades in the audit of large listed and unlisted entities. And he has experience in handling the national GAAP, Ind AS, or the accounting standard framework, or the IFRS and US GAAP, and also the auditing standards, international auditing standards on auditing, as well as essays in India, plus PCOB audit standards, etc. And again, he is also, like Amitesh Dattaji, interested in upskilling the various juniors and young professionals in his firm. And he has, in addition to serving clients, he has also experience in risk management function within the firm, which many of us you are hearing about this. There are the quality control standards, etc., which now currently focus more on the risk within management within the firm, etc. With this quick introduction of the speakers, now I will open the I request these speakers to start the session. But before I do that, just I want to have a quick sort of disclaimer, standard disclaimer, which many regulatory bodies and others which we have. Basically, what I want to say is the views and the opinions expressed in this webinar are solely those of the individual speakers or the officials like us, and those do not represent the views of the executive body or the NFRA. And the information which is provided in this, of course, it is quite useful. It will be useful and you can use it, but it's only for informational purposes and it's not sort of a professional authoritative advice. And you need to exercise your professional judgment and use the based on the circumstances applicable to you. You have to apply your judgment. So with this quick introduction of the speakers, and once again thanking the executive body, NFRA, and other senior officials here. So I will now request the speakers, Amitesh Datta as well as Sahil Arora, to take this session forward.
Thank you very much, Kulkarni and Shyamji. Am I audible? Is it clear?
Yes, absolutely.
Okay, thank you. Thank you so much for that kind introduction. And Kulkarni, I echo your words. I think it is very, very important that the NFRA is taking these steps in terms of disseminating more knowledge trying to disseminate more knowledge to the audit profession, and obviously to help the entire profession enhance the quality of our audits. Now, coming to today's session, it's the audit documentation session. Now, if you look at the theme, as Shyamji was talking about the theme, a thinking audit and not a ticking audit. That's actually very, very interesting, because if you think about audit documentation is what makes the auditor a thinking auditor. At the end of the day, it is the audit documentation through which the auditor can demonstrate the professional judgment, the professional skepticism, as well as all the procedures that have been performed and all the conclusions that have been reached to be able to issue the audit opinion at the end of the audit. And I think that's why it is a very apt theme which has been selected. At the end of the day, it has to be a thinking audit. It requires the auditor to ultimately put down the thought process that the auditor has applied during the course of the audit and at every point in the audit. And as Shyamji was saying, it should not remain a ticking exercise, because I think at the end of the day, if you see what is the purpose of the audit, is to build trust in the capital markets. And to build trust in the capital markets, it cannot just be a ticking exercise. It will have to be much more than that. And that is where audit documentation actually comes in very handy for us as auditors. So moving on for the contents for the day. So we've got two sections essentially where we'll talk about audit documentation. In section 1, what we will do is we will give you an overview of SA 230, which is on audit documentation, and that is the principal standard which governs audit documentation. Then in section 2, what we will do is we will do a case study, and the intention here is to actually discuss audit documentation in the context of audit strategy and audit plan. So essentially, we will run a case study through these various phases, planning phases and audit strategy phases, to try and illustrate and demonstrate the audit documentation. And as again, Kulkarni was saying, this is just illustrative. This is not authoritative guidance. This is just indicators of what one needs to think about as an auditor when planning the audit and when designing the audit strategy. So if you look at 230 is actually pretty broad. There is a specific definition to audit documentation. And if you look at the first two lines on this slide, it actually captures that. It says that audit documentation is a combination of the record of audit procedures performed. So that is the procedures that the auditor will perform in executing the audit, planning the audit, as well as coming to the various conclusions. The audit evidence that is obtained during the course of performing those audit procedures. So a record of the audit procedures will also need to be kept and is required to be kept under this standard. And ultimately, of course, it is a combination of the evidence, the procedures, which allows the auditor to come to a conclusion on the basis of which the opinion, the audit report, is issued by the auditor. If you look at the boxes below, just go back to the earlier slide. If you look at the boxes below, it is very broad. It is all encompassing. It will cover all kinds of audits that the auditor does. Typically, we talk in the context of statutory audits, but it will also apply to, let's say, limited reviews and various other kinds of audits of other historical information, which typically an auditor would do during the course of their duties as an auditor. Now, SA 230 also gives very specific instances of the purpose of audit documentation. And if you look at the left-hand side of this slide, it actually captures what is the purpose of audit documentation. Essentially, what SA 230 says is that audit documentation is something which runs through the entire cycle of the audit, right from planning the audit, to performing the audit, to then evidence obtained from the audit, as well as the conclusions that are reached for the audit to issue the audit opinion. So it runs through the entire cycle of the audit, right from planning to execution of audit procedures, to conclusion of the audit and issuance of the audit opinion. It also has other purposes. During that course of the audit, it also actually assists in supervision and direction of the audit as well. Now, it also points towards accountability, because as auditors, we will work as a team. There will be people who will be performing the review process, who will perform in the supervision process, and there will be people who will perform the procedures. So it actually creates accountability for each of us as chartered accountants and as auditors. And ultimately, of course, it also enables demonstrating that the audit has been conducted in terms of the quality control procedures under SQC1. It also says that where there are external inspections, audit documentation is what will help the external inspector understand whether the audit has been performed in compliance with the auditing standards. Now, if you look at the right-hand side, and which is actually a very critical part which all of us needs to understand, because as you know, every auditing standard has an objective. And every auditing standard says that the objective of that standard needs to be met while performing the audit. SA 230 also has specific objectives, and it says that the audit documentation should be in such a way that it provides a sufficient and appropriate record for the basis of the auditor's opinion. And that is very important, because ultimately it's the issuance of the opinion, the audit opinion, and the audit documentation should actually support that. The conclusions reached for the opinion should be clear from the audit documentation that the auditor maintains. Also, it is also evidence. The audit documentation is also evidence that the audit was performed in compliance with the standards of auditing, as well as other legal and regulatory requirements. So, for example, in compliance with the Companies Act, where there are specific provisions of the Companies Act which are required, let's say, for a statutory audit or any financial statement audit. So these objectives I would request that you keep in mind, because ultimately this is what drives audit documentation. Ultimately, this is what drives compliance with the requirements of SA 230. Now, as I said, there are certain requirements of SA 230. And I will quickly go through those. And of course, as I said, we will also demonstrate these by way of a case study after this. Now, the first part that you see talks about timely preparation of audit documentation. What does that mean? Essentially, what that means is that audit documentation that is prepared at the point in time when the work is performed, when the audit procedures are performed, is likely to be much more accurate, much more relevant than audit documentation that is prepared or audit documentation that is put into the audit working paper file after the audit work has been concluded or after the audit procedures have been performed. So there is a concept of contemporaneous documentation. Essentially, it is talking about putting down your documentation as you perform the procedures, recording your audit documentation as you perform the procedures. And that is very important to understand, because that is what this timely documentation is what actually enhances the quality of the audit. And it also facilitates effective review and evaluation of the audit evidence after the audit is performed. If you look at the second part of it, and this again goes to the very core of what should audit documentation be? As I said, it is a documentation of the evidence obtained as well as the procedures performed. But there is a context to this. The context to this is that the documentation should be in such a way that an experienced auditor who has no connection with that audit should be able to understand the nature, timing, and extent of the procedures performed, the results that have been obtained, the conclusions that have been reached, how were the significant issues dealt with, what were the conclusions on the significant issues, and very importantly, something that we all say, something that we all do during the course of an audit, exercise professional judgment in reaching those conclusions. That has to come out very clearly. The professional judgment, the professional skepticism, the rationale, the thought process of coming to a particular conclusion based on the evidence obtained it is very important that all that is documented in a very clear manner in the audit working paper files. When that is documented, it is also required that that experienced auditor, as I said, with no record or no connection to that audit, is able to understand the evidence that is gathered. And therefore, there needs to be clear identifying characteristics of the audit evidence that has been obtained. So just to take a simple example, let's say we are auditing sales for a particular company. And if you're auditing sales and you're looking at sales invoices, typically what SA 230 would require is enough is documented in the audit working papers to be able to identify which invoices were tested and in what manner it was tested by the auditor. So for example, the invoice number, the invoice amount, the date of the invoice, let's say the customer, some of these key characteristics, identifying characteristics and specifics will need to be documented. Along with that, who has actually performed that procedure? And when was that performed? This goes back to, again, timely preparation of audit documentation. It corroborates with that. And ultimately, of course, the review process, the extent of review, as well as the date of review. All that is required to be documented. There are situations where, let's say, one may need to depart from a requirement of a particular auditing standard. What SA 230 says is, if in those exceptional situations, the auditor is required to depart from the requirements or objectives of an auditing standard, the reasons for that departure has to be clearly recorded. What are the alternative procedures that have been performed and how do they meet that objective or the requirement of the auditing standard? That also needs to be documented. Again, as I said, these are exceptional situations. The rule of thumb is that typically we would not like to depart from the requirements of the auditing standard, and we would like to meet the requirements of the auditing standard. Moving on to the next bullet, number 4. If there are situations or matters which arise after the date of the audit report, again, very unusual, very exceptional, but yes, one can't rule it out. It could happen. What happens then? That you come across new evidence after the date that the audit report is issued. The auditor is actually required to record what was the circumstances in which that new information has come in. What was the nature of that new information? Were procedures required to be performed? And what were those additional audit procedures? What was the additional audit evidence? And as a result of those procedures and evidence, what was the conclusion reached? And was that conclusion actually different from the earlier conclusion? Also, it is required to say when and who performed the review and what were the changes to the audit documentation. Finally, if you look at the assembly of the audit file point, which is there in audit documentation, and again, this is very critical because, as I said, you perform an audit and you try and do all the documentation and you complete all the documentation under SA 230 before the audit report is issued. And before the audit report is issued, there is also a requirement that there is enough documentation in the file to support the opinion. And then there is this concept that a 230 brings in, which is assembly of the final audit file, which is again required to be done on a very timely basis. And there is a retention period also. In India, typically retention period is governed by the Companies Act. Typically, of course, there could be other acts also which have their own retention periods. But when we talk about the retention period is in the context of the Companies Act. If there are any changes made to the audit documentation that was prepared during the audit, the nature of the modification along with the reasons, as well as who reviewed it, when was it reviewed, and what were the procedures that were performed, that is something which is required to be also documented. So that provides you a very quick summary of the purpose of 230, the objective of 230, as well as some of the key requirements of SA 230. Now what we will do is we will get into the next part of this discussion, which is essentially taking a practical example and trying to demonstrate some audit documentation in the area of audit strategy and audit plan. Again, all in the context of the requirements of SA 230. So I would request my colleague, CS Sahil Arora, to take us through the next few slides. Over to you, Sahil.
A very good evening to everyone. Before I proceed, I just want to quickly check that my audio is okay. Kulkarni-ji, is my
Yes,
audio?
absolutely fine. You can go ahead. Thank you.
All right, thank you. So thank you, Amitesh. That was an insightful session. And now that we have all refreshed our understanding of the requirements of SA 230, we will proceed to look at the practical application in the planning phase of the audit, and more specifically around the requirements or documentation of audit strategy and audit plan. At this stage, it's important that although we will be discussing some of the broad requirements of certain standards of auditing that are related to certain topics that we'll cover in the planning phase, the objective of this session is to look through those requirements through the lens of SA 230, right? Focusing on the kind of documentation the auditor should maintain with respect to the planning procedures that they perform, as well as the judgments that they exercise in this phase of the audit. This then, would help the auditor to demonstrate and evidence that the audit was indeed planned to be performed in accordance with the requirements of the SA as well as the legal and regulatory requirements that are applicable. For this purpose, we have planned this session as a case study, as Amitesh mentioned, where we will look at the documentation for a fictional entity and look at how the audit strategy and audit documentation could be put into place looking through certain planning activities that we perform. To aid this discussion, we have bifurcated this into 3 distinct phases. The first phase is the activities performed for identification of risks. The second phase is the assessment of risks. And finally, we look at documentation of the audit strategy, audit plan to address the risks that have been noted by the auditor. Just a quick reiteration, as previously mentioned by the earlier speakers, the documentation that you'll see on the subsequent slides is for illustration purposes only, and is in the context of the case study that we would put in place and present to you. And actual documentation would probably need to vary depending on facts and circumstances of a particular audit engagement and the judgment of the auditor. With that, we move on to the profile on your screens. You will see a quick profile of the entity, the fictional entity that we are looking at for the purposes of demonstrating the audit planning and audit strategy documentation. So this is a manufacturing company dealing in the PVC manufacturing space. It has a few plants in India and a head office in the NCR region. It's also a holding company with 2 subsidiaries and an associate, and its shares are listed in stock exchanges in India. As part of the case study, we also note that the share price has seen a recent decline, causing the market capitalization to go below the carrying value of the net assets. Now let's begin the first phase, which is identification of risks. So we are all aware that the first part of building any kind of audit strategy is to perform procedures to identify risks associated with an entity, both at the overall financial statement level as well as the assertion level. On this slide, we have illustrated some of the activities that the auditor would need to perform to go down this route. This starts from acceptance and continuance procedures to determination of materiality and various other procedures that are listed on the slide, which help the auditor get an understanding of the entity, the environment in which it operates, the risks that it is exposed to, and ultimately help the auditor in determining which of those risks are relevant audit risks that they need to address as part of their audit plan and audit strategy. Please note that this is not an exhaustive list and a fixed list, and the auditor would need to add or modify procedures depending on the facts, circumstances. For example, in a joint audit situation, the auditor would also need to consider planning with respect to such an engagement. For the purposes of this exercise, out of the list that you saw in the previous slide, we are going to illustrate the example documentation or illustrative documentation for 5 of these activities, considering the time allotted for this webinar. So very quickly, moving on to the first one, which is around acceptance and continuance. So we are all aware that SQC1 and SA220 require an auditor to perform acceptance and continuance procedures to evaluate a client relationship as well as engagement continuance. When should this procedure be performed? So the requirement is to perform these procedures prior to accepting a new client or when deciding to continue with an audit engagement for an existing client, and also when evaluating to accept a new engagement for an existing client. So for example, if there are any new non-audit services out of the list of permissible services, at that stage, again, even though it's a continuing client relationship, the auditor will need to perform an assessment to evaluate whether they can accept that engagement for the client. Now, the auditor would need to get a broad range of information as part of these procedures. Some of them are illustrated on this slide, and maybe I can talk through some of the examples. This would include understanding whether there are any changes in the group structure or any new services that could potentially lead to any independence conflicts with respect to the audit engagement. Any factors noted with respect to conditions that would indicate that the entity might have difficulties in meeting its obligations or indicative of a going concern issue. Any adverse market-related indicators that may affect the entity. What is the financial reporting framework? Is that an appropriate financial reporting framework? Are there new requirements, legal, regulatory, that would impact the entity, and how that would expect to play out as far as the audit is concerned? Any continuing matters from the previous engagement that would have a bearing on the auditor's audit for the current year, that would also need to be looked at as part of this assessment. How the entity controls or the various operating units, again, an important factor when deciding to accept an engagement or continue with a continuing audit relationship. And another important question is around whether there are any indicators or adverse reportings around the integrity or conduct of the senior management or directors or the owners of the entity, right, or the legality of their actions, which could have an overall overbearing impact on the relationship. So in terms of continuance, when should this assessment be performed? Ideally, it needs to be performed at least on an annual basis and prior to execution of your engagement letter or commencement of the audit. But you will, even after this assessment, you may need to perform a reassessment depending on if there are new facts that emerge which are different from the fact on the basis of which you completed your earlier assessment. To meet the documentation requirements, the audit file should have a tabulation of all the responses to the various questions that have been assessed, along with any supporting documentation. So, for example, if there are any anti-money laundering checks that have been completed, that, or if non-audit services, permissible non-audit services have been performed, and the auditor has evaluated that the prior approval requirements from those charges of governance has been met, and evidence of that, and so on and so forth. To meet the documentation requirement, the documentation should also include a summary of the significant matters that get noted as part of this assessment, as well as the engagement partners' evaluation of these matters and the overall approach to deal with these matters. Evidence should also be there in the audit file to demonstrate that the assessment was performed and reviewed on a timely basis, both by the engagement leader or the engagement partner, as well as other designated reviewers in an audit firm. For the purposes of our case study, basis the facts that we noted as part of the profile of the entity, the auditor of our case study entity has noted that the share prices have fallen which has pushed the market capitalization below the carrying value of its net assets, which is an indicator of impairment in the carrying value of PP&E. And accordingly, as part of the acceptance and continuance procedures, the auditor has documented or identified this risk as a potential risk to be evaluated in the next phase of the audit. Moving, we look at the illustrative documentation for our case study entity in the area around getting an understanding of the entity and its environment. Now, we are all aware that SA 315 requires an auditor to get a deep understanding of the entity, its processes, the regulatory environment or external environment in which it operates, which includes its competitors, the macroeconomic environment, the various regulations or laws that impact it, how the entity is organized internally in terms of their operations, the governance structures, how they are funded, what are their investment strategies, the election and the selection and application of accounting policies, and so on and so forth, which help the auditor get a better understanding of the entity and the risks that they are exposed to. As part of our case study, now let's look at an example of the documentation to meet the requirements through the lens of SA 230. You will note that the auditor of our case study entity, XYZ Limited, has noted the industry information, including the estimated revenue growth trends over the next couple of years, as well as certain potential issues around sourcing of raw material that the entire industry is facing. In terms of regulatory updates, besides the various matters noted on this slide, the auditor has also noted a new regulation around chemical waste disposal guidelines that are applicable to the entity and could have a significant impact on the way in which this entity operates. The auditor also has captured the competitive environment, who are the main competitors, what are the various laws applicable on the entity, as well as the applicable financial reporting framework used by the entity. The auditor has also documented the various aspects in understanding how the entity is organized, right, in terms of its operations, the governance structures, the investment strategy, how it is funded, etc. And you will see an illustrative documentation on the slide in front of you. Again, as part of this exercise, the auditor has noted another potential risk and added that to the risk bucket, which is potential non-fulfillment of the new chemical waste disposal guidelines that are applicable to the entity from the current financial year. Next, I move to an important planning activity, which is determination of materiality. You are all aware that the determination of materiality is a matter of professional judgment, and it is also affected by the auditor's perception of the financial information needs of the users. The auditor applies the concept of materiality both in planning as well as performing the audit, as well as evaluating the impact of any misstatements identified during the audit, as well as any uncorrected misstatements and the impact of those on the financial statements or on the audit opinion. SA 320 states that when designing an overall audit strategy, the auditor is required to establish a materiality for the financial statements as a whole. Additionally, the auditor is also required to develop or determine a performance materiality for the purposes of assessment of risk, as well as determining the nature, timing, and extent of further audit procedures. Additionally, where circumstances are such that misstatements of an amount lower than the materiality that has been set for the financial statement as a whole could expect to influence the economic decisions of users for particular class of transactions, account balances, or disclosures, the SA 320 requires that the auditor shall also establish a specific materiality for such account balances, classes of transactions, and disclosures. With understanding those broad requirements, again, now we move on to the practical application for our case study, and let's look at, what are the factors in that the auditor of our case study entity has noted and documented, and on the basis of which, the materiality has been determined. First, we start with the materiality for financial statements as a whole. As I previously mentioned, it is a matter of exercise of professional judgment by the auditor. Typically, a percentage is often applied to a chosen benchmark to determine this materiality limit. The benchmark that gets chosen for determination of materiality would depend on multiple factors. The elements of the financial statements, for example, the assets, liability, income, expenses, what part or what items are of particular interest or focus of the users of that entity's financial statements. So, for example, for a profit-oriented entity, which has stable profits over the years, and a public interest entity listed on the stock exchange, profit is a key consideration, and it's always a key consideration for the users of the financial statements. Another factor that could impact is the nature of entity. For example, if it is an entity providing cost plus services on a cost plus basis to its parent entity and only captive services, or it's an asset management company where total assets, are probably a more relevant benchmark for the users of financial statements, and also where the entity is on its life cycle. So, is it a startup entity? Is it in the first few years of formation? Has it achieved break even? Is it close to that? So all of these factors need to be considered by the auditor to apply professional skepticism and exercise their judgment and determine the materiality. For our example, the auditor has evaluated the facts of the entity that we looked at earlier, the fact that it's profit oriented, the fact that it is a public interest entity, it does not have any high levels of external debts, etc. And on that basis, the auditor has determined the materiality for financial statements as a whole at 5% of total profit before tax for the year. Next, we look at the determination of performance materiality. So here the auditor has looked at factors and documented the factors, including a limited history of misstatements identified in the prior audits, the lower degree of aggregation risk and overall risk of the engagement, as well as expectation of the controls to be generally effective. So based on this, the auditor has determined the performance materiality at 75% of the materiality for the financial statements as a whole. Now, for this case study, the auditor has not noted any factors because, which would lead to them to determine a specific materiality for any class of transactions, account balances, or disclosures. But that could very well often be the case. And an example of that would be an entity which is in the pharmaceutical industry, where research and development expenses disclosure is often a key area of focus, or where the regulations or the financial reporting framework are expected to influence the expectations of the users on the measurement and disclosures of certain line items. For example, related party transactions, unrelated disclosures, or the remuneration of directors or senior management of an entity, or certain aspects of the business which are disclosed separate in the financials, which could be an area of focus. For example, a newly acquired business. So the auditor needs to be aware of all of this, because if circumstances do exist, it's not a matter of choice. The standard again mandates that the auditor should look at this, assess it, and determine a specific materiality for these specific classes of transaction, account balances, and disclosures. Next one that we are going to cover as part of the case study are the requirements around going concern assumption. Now, the reason we included this as part of the activities was to illustrate that this is applicable to every audit engagement, right? Whether or not there is a history of this becoming a critical matter or not. So SA 570 requires varying degree of responses from the auditor basis their assessment of the factors that could indicate that the entity may have uh, uh, a condition where it is the going concern assumption. There may be a material uncertainty with respect to going concern assumption, or it may not be valid. And the auditor is required to evaluate all of these factors, which are financial, operating in nature, to exercise their judgment. Now, does this mean that it's an arithmetic yes/no exercise in terms of evaluation of the factors? The answer to that is no, right? After these factors are noted, the auditor needs to exercise a judgment to make to form a view whether going concern is a risk that needs to be built into the audit strategy at the planning stage, and if so, what are the procedures that needs to be planned to address that risk. In our case study, the auditor of XYZ Limited has not noted any conditions or event that may cast a doubt on the ability of this entity to continue as a going concern in the planning stage. But like I mentioned earlier, the auditor has evaluated the factors leading to this conclusion and how they have exercised the judgment and documented as part of their planning documentation. Next activity that we are going to look at are the documentation of analytical procedures at the planning stage. Now, we are aware that SA 315 requires an auditor to perform risk assessment procedures as a basis of identification and assessment of risks, right? Analytical procedures performed as risk assessment procedures could include both financial and non-financial information. Like, it could be a relationship between the sales and the underlying, the volume of goods that are dispatched, etc. It's a very important tool, and we've listed down some of the commonly used analytical procedures in the slide, which are trend analysis or ratio analysis or fluctuation analysis. And it's a powerful tool as it could provide an indication of a risk of misstatement, material misstatement that the auditor has not noted as part of the other procedures, or looking at documentation and documents and other procedures that have been performed. By looking at unusual fluctuations or relationships in the data, right, or inconsistencies with what the auditor expected to see as results, based on the key drivers that they noted through performance of the activities or planning activities that we illustrated in the slides earlier. This is now again an illustration of documentation of analytical procedures. The auditor of XYZ Limited, in our example, has chosen to perform fluctuation analysis both for the income statement and the balance sheet. Before they set out for analyzing the fluctuations, the auditor has also documented three important aspects, right? The first is to develop current year expectations based on all of the factors that we noted. So for example, if you recollect, we looked at the growth rate trends of the industry, and we also performed procedures to understand the growth rate for the entity. Now, if you look at that, the auditor has documented that and has also looked at the actual fluctuation to determine whether it's in line with the expectation. To do this, the auditor has also done the second important activity, which is to set a threshold beyond which a variation or a fluctuation would be considered unexpected or unusual, requiring further analysis or further evaluation by the auditor. And the third and the most important is that the auditor should also document the basis on which the data that is being used for the analytical, that is deemed to be reliable, because that would have a direct impact on any kind of outcome of any analytical procedures. As I mentioned earlier, the fluctuation analysis on the statement of profit and loss did not show any unusual or unexpected trend, and the auditor was able to correlate with their understanding of the business and expectations that were drawn for this year. However, when they went on to perform procedures on fluctuation analysis on the balance sheet items, and here is an extract of that is documented here. There was a variation noted, which was unusual with respect to the inventory or provision for warranty. Now, this could be because of a change in methodology, or a change in or because of a incorrect computation or any other factor, but definitely sits in unusual and not in line with the auditor's expectation. This would be indicative of a potential risk that the auditor should take cognizance of while designing their audit plan for the current year. With that, we come to the conclusion of phase one of the activities, where we've illustrated few examples of the planning activities that will be performed for determination or identification of risks applicable to an audit engagement. Just to summarize, these are three of the risks that were noted as part of the illustrate planning procedures that we spoke about earlier in the session. The first one, if you remember, during the acceptance and continuance phase, there was a risk of impairment or potential risk of impairment of carrying value of PP&E that was noted by the auditor. During understanding the regulatory environments and the new regulations applicable, the auditor noted a risk of non-fulfillment of chemical waste disposal guidelines that were applicable from the current fiscal year on the entity. And in the last slide on the analytical procedures, another risk with respect to computation of warranty provision was identified. Now, as we move on to the phase two and phase three, for the purposes of this session, we are going to illustrate that for a particular financial statement line item, namely property, plant, and equipment. So, beginning with that, we are aware that SA 315 requires the auditor to exercise judgment to assess the level of inherent risk and categorize the various risks between significant risks and other risks, so that an appropriate audit response can be formulated. Some of the factors that the standard requires the auditor to consider are the complexity of the transactions, the degree of susceptibility of measurement of financial information, as well as the measurement uncertainty, whether the risk is related to a new regulation or accounting or significant economic development, and therefore requires a specific addition. So, it's susceptible to, it's basically a change from status quo, as well as certain factors which have a inherent high fraud risk. So for example, significant transactions with related party or transactions outside the normal course of business, that appear unusual, etc. Now, again, we will look at illustrative documentation for our case study. So the auditor of XYZ Limited has determined 5 relevant risks for property, plant, and equipment financial statement line item, which are documented on this slide and the next slide, right? Let's look at the first one a little bit more in detail. So this is related to the risk of impairment in carrying value of property, plant, and equipment, which affects the valuation assertion in the financial statements. Now, the auditor has looked at this risk through the prism of the factors mentioned in SA 315 and has noted their conclusions and given an overall risk rating. It's very important that the auditor also documents the basis of this determination. So for example, in this case of XYZ Limited, the auditor has evaluated the complexity to be high because of the complex value in use computation that the particular client has chosen. The subjectivity uncertainty is also going to be higher than normal, because the financial model for determination of the carrying value basis the value in use is going to be based on projections, is going to have assumptions that would have a high degree of uncertainty and susceptibility, subjectivity, and could be subjected to management bias. We also noted that this is the first year that the entity was exposed to this scenario. So change has also been assessed as high. And because profitability, and we noted that earlier in our discussion as well, being a profit interest, being a PIE entity, profitability is a key factor in evaluation of the entity and the performance of the management. The fraud risk factor is also assessed as higher than low. So this is the methodology or in which the standard requires the auditors to assess all relevant risks and have sufficient documentation in the audit file to be able to demonstrate exercise of professional skepticism and exercise of an appropriate judgment to determine the assessment and categorization of risks. Now we move to the final phase that we have in the session, which is around the documentation of the audit strategy and the audit plan. Again, we are going to use property, plant, and equipment as the line item that we are going to focus our discussion on. You're aware that the audit strategy would consist of both the control testing plan as well as the planned evidence that the auditor wants to gather through performance of substantive procedures. The first demonstration or illustration for XYZ Limited is of the control testing plan, where the auditor has identified certain controls. This slide depicts the two controls that the company has in place, which directly address the significant risk related to the property, plant, and equipment line item. The next slide has the controls that have been mapped to the other risks that are still relevant, although not assessed as significant. Once the auditor is satisfied about the design effectiveness of the controls that the management has in place, the audit plan should also have documentation around the nature, timing, and extent of procedures that the auditor plans to perform to gather evidence around operating effectiveness of the controls. Next is the substantive testing plan. Again, this is the illustrative documentation for XYZ Limited, where procedures have been planned by the auditor and documented, and also specifically mapped to the relevant assertions for the property, plant, and equipment line item. So you will see procedures around reconciliation of the fixed assets register to the general ledger, helps with the you gather evidence of the completeness assertion, procedures to verify the underlying documents supporting additions and deletions of property, plant, and equipment, which help with the occurrence assertion. Similarly, procedures for verification of title deeds and testing the value in use computation, etc. Which are mapped to the relevant assertions. With this, we come to the end of the case study, depicting the illustrative documentation for certain planning activities, as well as the assessment of risks, identification, assessment of risks, and what could the documentation for the audit strategy, control testing, as well as substantive procedures could look like. Very important to reiterate that this is just illustrative documentation. The key is that the auditor must ensure that the documentation is complete and concise and able to communicate to an experienced, unrelated auditor that the audit, that the professional skepticism, professional judgment is applied, and the actual documentation would invariably be different in different audit situations, as well as due to exercise of professional judgment of different auditors. These are some of the resources. So, we would encourage you to read the standards on auditing related to some of the topics that we covered, as well as certain tools and practices that are available in the public domain, including certain implementation guides and checklists that have been published by the Institute of Chartered Accountants of India. That brings us to the end of our presentation. Thank you for being patient with the listening. And I hand it over back to the moderators now for the Q&A section.
Thank you, Sahil and Amtesh. Very good sort of, you can say the explanation around, sort of critical areas of, documentation perspective in the initial stage of the, phase of the audit. It is, as very clearly mentioned, documentation is, throughout the entire audit process. But this is, we want to focus, basically on the practical side of things, and bit by bit, sort of rather than taking everything at one. And this is a planning stage, and that in that documentation of the overall audit strategy perspective, very nice sort of an explanation of that. What are the various things one is expected to do during that phase of that. So we have, there are some questions which the audience has asked. I'll pose those questions to you. Before that, Amitesh, would you like to add anything, any important thing, or if you want to highlight anything more before I just pose some questions to you?
Sure. No, thank you so much. And thank you for
Yeah.
that summary, Kulkarni-ji. I think the message that, again, I would like to leave the participants with is to say that do not underestimate the power of audit documentation. I think at the end of the day, if you really look at, if we say, when we talk about court judgments, when we talk about, the orders that are written by courts, we talk of something which is called a speaking order. Essentially, what a speaking order means is that it actually explains the process by which that conclusion or that order was passed, let's say by the honorable judge or by the honorable court. You can actually draw an analogy to audit documentation to say that audit documentation is actually what allows an auditor to do what you would term, in the way in which I'm saying it, as a speaking audit. So essentially what that would again go back to is the theme of the audit, theme of your session today, to say a thinking audit rather than just a mechanical tick box approach. And I think at the end of the day, that is the reason why audit documentation is so much relevance. We all perform procedures, we all exercise our professional judgment. We have all our thought processes, rationale to do things in a particular way. So for example, materiality is completely the professional judgment of each auditor, and that is something which could be different. Something that I would look at is material, something that you may look at is not material. But what is important in that entire assessment is to put down my rationale, my thought process as to why I believe why something is material and why something is not material. Because ultimately that judgment could be very different from person to person. And how will you put that down? If it is verbal, if it is not documented, it is very difficult to recreate at the time when that is required. And that is the reason why documentation, when those assessments are made, when those professional judgments are made, will actually allow the auditor to demonstrate how the audit was done. Compliance with auditing standards is very important, but more importantly, the trust in the audit, the trust in the capital markets will ultimately come with where a quality audit is done and the audit documentation speaks to how the audit opinion was issued and what were the evidences, what were the procedures that were considered to issue that audit opinion, be it a clean opinion, be it a modified opinion, whatever it is. That conclusion is the professional judgment of the auditor, and it will depend from case to case, circumstance to circumstance. But whatever be that judgment, whatever be the final conclusion, that audit documentation should be robust enough to back up that judgment that was made by that particular audit. So Kulkarni-ji, Shyamji, I would like to leave it there because I think the to me what resonates is actually the theme that has been selected, thinking audit. And I can't think of a better way that I can demonstrate myself to be a thinking auditor than putting down what I'm thinking on paper, which is essentially audit documentation.
Yeah. So we can say that audit work not documented means audit work not done.
Absolutely. Absolutely.
Yeah,
Not
I think
documented means
a
not
few
done.
questions from our audiences, and Ramesh Jain asks the question on documentation on going concern suggested only includes those prepared by the auditor. There is no reference to documentation of management assessment of going concern.
So Rameshji, you're absolutely right. So just for illustration purposes, if you look at SA 570, and even if you think about it practically, it is the management, it is the company which will need to assert that it is a going concern. Financial statements will always be prepared on a going concern basis, because if the going concern assumption is not valid, the normal accounting framework does not apply. You will go back to realization basis auditing. So yes, you are right. This was only for illustration purposes. Management's assessment of going concern is very, very important. That's actually step number one. Management will make the assessment, and under the procedures that are mentioned in 570, the auditor will perform those procedures. Where there is a doubt, where there is a significant uncertainty, where there is, let's say, material uncertainty, the auditor may then choose to perform extended procedures. Those procedures will be performed on the management assessment of going concern. And you're right, that needs to come out right on top. And that is what the auditor will ultimately assess to say, is the going concern assumption valid, or is the going concern assumption not valid for that particular audit? I hope I've answered the question.
Maybe Amitesh, another way also could be also like this is a documentation is at the planning stage. Probably here you will try to look at, are there any indicators for one has to really look at in detail the going concern, and by doing analytical procedures and other review, and as we go along during the execution stage of the audit, and that point of a time you will have a much more you will be looking for the management assessment documentation, other things, which there obviously then you will the like other standards require, as you mentioned, that is 570. There one need to auditor definitely need to obtain that documentation and also evaluate that documentation. I would say it is not just taking the copies at the end of the audit and saying that yes, management gave me this. That is, I think, if you see some of our NFRA orders, there are in a couple of cases these things which are noted that the management documentation was there, but the auditor's evaluation of that documentation was probably sort of missing. So good. This the point which very rightly the audience has asked this particular question.
Yeah, no, I agree with you. I agree with you. See, that is where the audit documentation will come in to say what was the evaluation of management's assessment of going concern.
Yeah.
And I think that is what Kulkarni are trying to refer to say, yes, management will have an assessment, but at the planning stage, there will be a view. And then obviously the assessment of the auditor's assessment of management's evaluation will also need to be there.
Yes.
So Vinayak asked whether recording will be available after this webinar. Yes, the recording will be available on the website. You can view it after the webinar. And one more interesting question is, Jaideep has asked Amitesh ji or Mr. Said, you can take this. Is there any difference between audit strategy and audit planning, requiring a difference in the timing of the activity for documentation? Can they be done together?
So if you ask me, they run hand in hand. They run hand in hand. So what is an audit plan? An audit plan is nothing but the response of the auditor in the auditor's professional judgment of the risks that have been assessed on the audit. Now, you could also call that the audit strategy. So you could use these words interchangeably, the audit strategy, the audit plan. You could use it interchangeably. I don't think there is any clear demarcation on what is a strategy or what is a plan, because ultimately what matters is whether it is the audit strategy or whether it is the audit plan. It has to be such, the plan or the strategy has to be such that it responds to the assessed risks by the auditor. And ultimately, that is the objective.
Another question, Sahil, which was there. You actually in the plan, the stage, documentation, you actually alluded to that fact, but maybe the question someone asked maybe a little bit more clarification. say, when understanding the entity, by understanding the entity, you will identify certain risks. And one of the question is increase in price of petroleum products. Like, what kind of a risk it throws up, or what auditor is expected to identify risk from that perspective. Is there anything, any thought on this? Which areas it might affect your audit?
Can you just repeat that question? A little bit
Yeah,
of
it's basically the increase in the price of petroleum, because this was an entity, I think, which the nature of the entity business was, I think, chemicals and petroleum. So increase in the price of petroleum products, what kind of a risk does it pose? That was the question.
I mean, that could have a impact on a variety of, considerations in the audit. First is with respect to the availability of the raw materials itself. So, when the petroleum prices rise, it will have a cascading impact on the prices of the raw materials, and that could impact, the availability as well. Second, it could affect the profitability of the organization. So, the judgments around the profitability would have to be looked at more closely. And thirdly, in terms of the inventory valuation, it could have an impact. So you might need to assess, any impact in the carrying values of inventory as well.
Question, which is another question which is posed. It's relating to a group audit. Here the question is, what procedure should an auditor perform to ensure the competence and capabilities of the component auditor? So, how do we build in this in the planning stage or the overall audit strategy? That's a question.
Yeah, so I think it is very important. If you ask me, it is very important at the planning stage, typically where you, let's say, issue a consolidated opinion. It is very important for the auditor to make that assessment of competence, objectivity, and capability of the component auditor. Now, how does one do that? I would say in our country, the first thing that you would look at, if it's a statutory audit, the component auditor will obviously have to be a chartered accountant. Now, being a chartered accountant clearly demonstrates that there are certain qualifications, there are certain knowledge bases that the professional has to be able to execute the statutory audit. So the competence typically would come from the qualification of the auditor, and to say that is the auditor qualified enough to be able to perform the audit at the level of complexity that is there at the component. The objectivity, of course, comes through the entire piece on integrity, independence, to say, is the component auditor independent of the entity? Is the component auditor also independent if it's a material subsidiary, independent of also the group company? That is the objectivity and the independence that comes. And of course, capability and competence, the way I look at it, it always goes hand in hand. Sometimes one looks at and says that, is the size of the entity such that it needs a lot more focus, and hence you look at the capability of the auditor from that angle. But this is in group audits, in audits where consolidated audit opinions are issued, this is a prerequisite where one will need to document the entire competence, objectivity of component auditors. More importantly, components which are material, components which are significant to the entire consolidated financial statements. There, of course, the component auditors, if they are different from the parent auditor, there are requirements under SA 600 which need to be performed and which will need to be done at the planning stage itself.
Yeah, one more interesting question. What kind of audit documentation is required or expected for assessment of fraud risk in impairment of investment and loans? If you can throw some light on this, yeah.
Yeah, so again, that's a good question, because I think the documentation on fraud risk assessment is a very important part and is a very important activity for the auditor to be able to demonstrate as part of, when we are talking about audit documentation, how is the auditor assess fraud? So when you talk about impairment of investments, what I can think of, and this is just, without probably a context of a particular case, but if there is impairment of investments, typically is there management bias? And is that management bias in making those impairment assessments intentional or unintentional? So that, to my mind, is something, when I'm just thinking about it as I speak, is something that could also point towards a fraud risk factor. And that is how typically you would look at some of these factors to say that what is the extent of fraud risk? Because there are some areas which are, susceptible to fraud. There is an inherent risk of fraud, and some areas which have a lesser risk of fraud. So impairment of investments, typically, if I was to think of, yes, the fraud risk assessment would need to consider if there are assumptions, if there are financial models that are used to look at the value in use, is there a management bias? Now, for some reason, is that management bias intentional because the management does not want to show impairment? So that is something that one may look at when they are, documenting the fraud risk assessment for impairment of investment.
Thank you for that response, Amiresh ji. Anisha is asking, can review report given by practitioner be taken into account?
Review report, I guess the question is around the limited review report, the review report
Yeah.
that is given for the purposes of the stock exchange results. I guess if that is the context, and taken into account for what, I guess if there is some clarity, taken into account for planning the audit, if that is the context, absolutely. Review report will give indicators. The financial results that are published by a company and made available in the stock exchange, that definitely will give indicators, and that could be used for the purposes of looking at assessment of risk, for the purposes of planning the procedures. If that is the context of the question, when it says can be taken into account.
So, yeah. There is another question, which is interesting one. That is in the context of money laundering risk, some sort of audit documentation. What kind of a documentation would be required? Is there something you can throw some light on that?
Yeah, again, it's a very complex area, very complex area. But yes, there is a requirement, I would say, that while performing the audit, if the auditor does come across suspicious transactions, if the auditor does come across, indicators that there could be some sort of suspicious transactions or money laundering activities that could be there, which is under the Prevention of Money Laundering Act, the procedures to perform, it would depend on case to case, because it would also depend on what is the red flag that the auditor is picking up for a suspicious transaction. We all know that there are these tax havens from where transactions take place. There are these shell companies nowadays where we hear of where transactions take place. So if there are such transactions, one red flag could be money laundering. And you will have to check whether it is contravening any of the PMLA provisions. You will have to check, because that is something which is there for compliance with laws and regulations.
Yes.
Yeah. So Tejas wants to know under what circumstances can materiality assessment can be changed, and how to record the same.
So I think, again, very good question. As Sahil was mentioning, there is a materiality which is assessed at the planning stage, right? Now that is based on information that is available at the planning stage. I mean, if I was to take an example, let's say it's a 31st March client, maybe you're starting to plan a little earlier on in the year, maybe a few months earlier. you probably don't have all the financial statement numbers. You make certain estimates of what they will be based on the budgets of the company or based on projections of the company, or in case of listed companies, if you already have 9 months results available, you can do an extrapolation to look at 12 months. And maybe you come to a materiality, which is an estimate at that point in time. It is actually a requirement of the standard that at the end of the audit, and when you are completing the audit, you are actually required to go back and see whether the materiality that was determined at the planning stage is still relevant. And the relevance is then assessed in terms of how have the financial statement numbers moved, which was used as the benchmark for determining materiality. If those numbers have moved such that the materiality should be determined at a lower level, then if there are misstatements that the auditor has identified, that will need to be reevaluated. The extent of audit procedures that has been done based on the earlier planning materiality or based on the materiality that was determined at the planning stage, if that benchmark has undergone a change and therefore the materiality level falls, the extent of work will again need to be reassessed. Maybe the auditor will need to do more work, more audit procedures. So I think, Shyamji, if you ask me, it is actually a required process. It is a requirement of the auditing standards that before you close the audit, you will have to reassess materiality. And that entire documentation of reassessment to say, in this example, let's say we used profit before tax, and there was a particular number of profit before tax that was taken. If that number has undergone a significant change such that the materiality has also undergone a change, all those assessments of misstatements, extent of work will have to be done, have to be documented. And then to say that the auditor is still comfortable and still there is sufficient appropriate evidence that the auditor is obtained to come to the conclusions that are there for the purposes of the audit.
So a connected question is, would this, assessment of materiality which undergoes change require changes in the audit plan? And does it need that the original or initial audit plan and the revision plan are both documented?
It could require changes in audit plan. So I'll give you a simple example. So there is an exercise which we call as scoping of the financial statement. So, based on your materiality, where certain financial statement items are material. Now, when I say material, it is obviously in the context of the materiality that the auditor has determined in the auditor's professional judgment. And let's say you've scoped in certain financial statement items for performing procedures, right? You've done your risk assessment, and your assessment of what is the risk of material misstatement at a financial statement level or at a disclosure level was keeping in mind a particular threshold of materiality. And then what happens is that, let's say that materiality falls. Definitely the audit plan will undergo a change. Definitely what you scoped in, maybe I'm just taking a simple example at random. Maybe if you scoped in 60% of the trial balance to perform procedures, 70% of the trial balance to perform procedures, because the others were not material, you might need to now scope in more accounts, right? You might need to reassess risk because your level of materiality, what you thought was material, has changed. And that thought process, because you would have already, as we spoke during the session, you would have already documented in the planning phase how you determine materiality. And as we said, towards the close of the audit, you're reassessing materiality. And if that reassessed materiality points towards saying that you actually needed to do more work, you will need to go back to your planning phase, because planning is an iterative process. If you look at 230, the way it is written, it is an iterative process. It runs through the entire audit. And therefore, you will need to go back. And you will probably need to say, okay, do I now need to change the way I assess risks? Are there more risks that come in? Let's say we spoke about analytical procedures. Analytical procedures also of what is usual, what is unusual, will have a quantitative metric and a qualitative metric when you're assessing what is usual, what is unusual. Now, if your materiality changes, then that quantitative metric for analytical procedures which you used at planning will change. So a number of things will get impacted where the materiality changes, and it is very much possible that you will have to revisit your audit plan. It is very much possible.
Interesting questions there, and some of which are questions where we would be covering in our forthcoming webinars, right? So that was wonderful on your part to take the questions, Samiteshji. So this brings us to the most important part of the session, to propose a vote of thanks, right? So distinguished speakers and participants, I have great pleasure to extend a heartfelt gratitude and sincere thanks at the outset to our executive body and to our honorable chairperson for their unwavering support for the conduct of this webinar. I thank our chairperson for his leadership and guidance, which have been instrumental in steering this event. So he is our guiding force. I would like to express my deep appreciation to our distinguished speakers who graciously shared their expertise and experiences during the webinar. Their presentation was not only insightful but also provided valuable perspectives, I think, which will undoubtedly contribute to the enhancement of audit practices. Your commitment to the exchange of knowledge is commendable, and we are grateful to both of you for your contributions. A special note of thanks to all the participants, especially to those who raised questions and shared their insights as well. So a big thank you to them. Your enthusiastic participation added immense value to our learning experience. So behind the scenes, our technical team of NAFRA and MCA worked very hard to put up this webinar. And I extend my sincere gratitudes to our NAFRA technical team as well as MCA technical team. I wish to place on record my sincere, thanks for the valuable contributions of my esteemed colleague, Mr. Vidyadhar Kulkarni, our senior consultant at NAFRA. He has been instrumental, I would say, in the planning and in the execution of the first webinar of the webinar series. We have 4 more webinars coming up in due course, and please save the is on 15th of February, and I request all the participants to save the date and to attend this webinar as well. So we look forward to this continuing journey of the knowledge sharing and professional growth. And I thank all of you once again for making the NAFRA webinar a memorable and enriching experience. So see you all on 15th of February in our next webinar on the NAFRA webinar series on audit documentation, thinking audit, not taking audit. Thank you very much once again. Thank you.